Gateway is like the Cheers of banking, where everybody knows your name. You get fast, personal service from a team who knows you and cares about you. When I joined the team that founded Gateway in 2007, we had a vision of building a community bank specifically for locals, run by locals. After over a decade, multiple recessions, and so many changes in the industry, we're proud to still be Mesa's only hometown bank. We specialize in helping local businesses grow with fast, easy financing and convenient banking products that make life simpler. When you work with Gateway, you can count on us for one-on-one attention, fast service from your dedicated banker, creativity and flexibility to meet your specific needs, and a true financial partner for life.
Hi, everyone, and thanks for joining us today. We're going to give everyone about another minute to join, and then we'll go ahead and get started. I'm also here with Josh Flake, Gateway Bank's Chief Credit Officer, and we're so happy to have you here today. So sit tight for about another minute, and then we'll go ahead and get started. All right. Hello, good morning, good afternoon, depending on where you're joining us from. I'm Shana Rosen with Gateway Bank, and I'm excited to be here with Josh Flake, our Chief Credit Officer, to talk about how to grow your business and navigate uncertainty in this current economic and business environment. We know that things feel really uncertain right now for many people, especially business owners, as we're navigating tariffs, rising costs, economic volatility. It can feel really difficult to even plan for the next few weeks, let alone the next few years. And a lot of business owners that we talk to, we hear are hearing about a lot of quick fixes to cover expenses and fund their growth. But those options can sometimes create longer term problems and put business owners in a risky cycle of debt. So that's why we're here today to talk about some different banking and lending solutions that can help cover those expenses, navigate uncertainty, and fund your growth, but without putting your business at risk. Josh Flake, Gateway Bank's Chief Credit Officer, is going to walk us through today. Josh has spent his career working with small businesses, first as a loan broker, helping entrepreneurs connect with the funding they needed to grow, and now at Gateway Bank, which if you are not familiar with Gateway Bank and not one of our customers already, we're the only community bank in Mesa, Arizona, serving customers across the valley and the country. And since joining Gateway, Josh has been really passionate about continuing to support local businesses, build those relationships, and guide business owners toward the types of smart financial solutions that we'll talk about today. We'll have plenty of time at the end of this webinar for questions. So as Josh is speaking, feel free to type your questions into the chat. I'll gather those and then we can share them at the end, and Josh can help answer those questions for you. So with that, I'll hand it over to Josh and we'll go from there. Over to you, Josh.
Yeah, thank you for that introduction, Shana. As Shana said, and if you've watched the news or been on social media or talked to anybody for more than 5 minutes over the last year, you know that there's a ton of uncertainty going on, both in the consumer as well as the business world, with everything from tariffs to inflation and interest rates and the economy in general. And so there's all this uncertainty going on, and that can certainly lead to a lot of rash decisions being made. And so when we started talking about doing this webinar, I knew right away that this is something that I wanted to talk about because unfortunately, I've seen too many times where these rash decisions with unfavorable loan products can really sink a business. And so for that reason, today we want to talk about how to navigate some of that uncertainty and make sound decisions for your business. If you are in a cash flow crunch or a growth mode, that will help make sure that your business is going to be around and successful for the long haul. So today, we're going to focus on the story of a real life customer of mine. I've known him for years. For confidentiality purposes, we have redacted his name, so we'll refer to him today as Dr. W. He's an amazing dentist, very strong producer, but he did find himself in a bit of a situation when he took out what are called merchant cash advances. And we'll get in later into exactly what a merchant cash advance is and why he took them out. But just so you have a snapshot to kind of keep in the back of your mind as we go through the rest of the presentation, I just wanted to show you up front what it looks like that he took out. So he took out 3 different merchant cash advances. You'll see in that first column there under principal, the total amount he borrowed was $680,000. And then in the next column are his monthly minimum payments. So you'll see it's pretty steep there, just over $53,000 a month he was paying for these 3 loans, which equated to just under $640,000 a year. So again, even with him being a great producer and a great dentist, paying $640,000 a year just for these 3 loans is going to strain the cash flow of any small business. His total payback on these 3 loans was $890,000. So just over $210,000 that he paid, and they don't term it interest, but again, we'll get into that more later in the presentation. But just over $210,000 that he paid in essentially interest outside of origination fees, as well as any servicing fees. So again, just keep this in the back of your mind as we go through the rest of the presentation here. So what we'll be going through today, we're going to talk about merchant cash advances, as well as another common quick fix for funding that a lot of businesses have been turning to, especially over the last several years with all of the uncertainty going on, really stemming all the way back to COVID. We'll also be talking about some of the advantages and disadvantages of those options. And then more importantly, we'll be leading into some better alternatives. So really options that you can choose that are going to be better fit for your business in the short and long term. And then we'll be ending with some tips for success. Again, if you have any questions throughout the presentation, please throw them in the chat. You know, I definitely want this to be a two-way communication here. So any questions you have, please throw them in there. And then as we get to the end of the presentation, we'll be sure to go over those and answer anything that anybody's asked there. And the top takeaway for today, so just to keep in mind, if you don't get anything else out of today, it's don't fall for those quick fixes. You know, a lot of these businesses that turn to those, it's either because they're in a really tight cash flow crunch in the moment, or they have a growth opportunity and they think this is the only way to take advantage of that. But they can really put your business at risk. And so while it may seem advantageous in the short term, really make sure that you're taking all the factors into account, because it's, at the end of the day, it's not worth it to put your entire business at risk when there are better options available. And then secondly, having a strategic trusted banking partner is going to help you to make those sound decisions. You know, if you own a plumbing business, you know, you're great at plumbing and that's, you know, your expertise. And so, but banking may not be. And so finding a trusted partner that's able to help talk through those options with you is vital. So even better if it's a local bank. Common challenges today. So this is really, you know, the meat of that uncertainty that we talked about up front is all stemming from kind of these 3 or 4 main areas here. So one of them is just really the difficulty in driving revenues due to increased competition in a lot of industries. We were just talking about this at the bank with a few of my colleagues the other day. one area we're seeing a lot is, and this happens in any upcycle, but is in the construction industry. A lot of contractors that have been in the industry for a long time and really know what they're doing. When there's an upcycle and there's a lot of demand for work, you see a lot of new contractors entering the industry. Some are great, some are kind of fly-by-night operations and may not have the experience or the knowledge necessary to get these projects done. But either way, they are added competition into your market. And so on that upswing, it's not necessarily as much of a concern. But as the market either corrects itself or we find ourselves in a down cycle, all of that extra competition can become an industry as work becomes more scarce. And then eventually some of those, contractors and some of that competition will fall off. And it's, virtually the same in any industry. But that's certainly something that is a concern for a lot of people right now. Next, we have rising costs due to inflation, tariffs, and more. And so, again, if you've seen, in the news, inflation is still well above where the Fed would like it to be. The Fed has set a kind of a target baseline that they would like it to be 2% or less. Right now, latest news was that we were at 2.92%. So we're still quite a bit above that 2%, which means that inflation is high. They're obviously working to try and bring that down. One of the things you've probably heard, the Fed's actually meeting today to discuss an interest rate decrease. And as of this morning, it was between 96% to 100% certainty that they would lower it by 0.25%. Much lower percent chance that they'll lower it by more than that. There was a 4% chance this morning that they might lower it by a full 0.5%. But that is one of the things that they're doing to try and fight that inflation. The other thing that you've probably heard a lot about in the news is tariffs. And it remains to be seen what the long-term effect of those tariffs are, but certainly some of the major tariffs that are affecting U.S. consumers and businesses are the tariffs on Canada, China, and Mexico specifically, just because of the business that we do with them. And so that's certainly affecting prices, at least in the short term. There's also been global tariffs on aluminum, steel, and other consumer goods, and that's certainly increasing prices as well. The long-term strategy there is hopefully to bring more jobs back to America. But again, that remains to be seen how that will work out. And so certainly in the short term, that's affecting prices and creating strain on a lot of businesses as the owners decide if they're going to eat those costs themselves or if they're able to, pass part or all of that on to the customer, which then also affects customer spending. So a lot of moving parts there that again are just adding to that uncertainty that's out there in the economy and creating that economic volatility that we talk about there. So these are all situations that business owners are facing in real time. And again, a lot of them are either it's creating that cash flow crunch because of the increased expenses and costs where they're not able to maybe make payroll or pay their supplier. And so they're faced with a situation where they have to figure out how to come up with extra money. Or maybe there's some opportunities that are created from some of these situations and their business is in growth mode, but maybe they need money for some new equipment or a big marketing campaign or to hire more staff. And again, that's a situation where these business owners are looking for quick access to capital so that they can take advantage of those situations. And so one of the most common quick fixes that's out there right now is a merchant cash advance. And again, if you take nothing else from this presentation, my advice with merchant cash advances has always been the same, is do not take one unless you absolutely have to. These are not a bank product. These are third-party lenders, mostly online lenders that are offering this product. I personally view it as predatory lending. They are able to skate some of the usury laws by not terming it as actual interest. Essentially, they have an upfront fee that they charge, which we'll get into specifics on what that looks like later on. But really, these are products where the lender is giving you quick access to that capital, sometimes as fast as 24 hours after application. But what they're doing then is they're taking control of your merchant services. And so any money that's, a customer pays with a credit or a debit card, that's being controlled by them. They're taking their piece of it out and they'll have either a minimum daily payment or a percentage of your credit card processing, whichever is greater. They'll take that on a daily basis, sometimes a weekly basis, but they'll take that automatically out before the money even gets to you. You'll also see these sometimes called revenue-based financing, short-term unsecured loans. The reason for that is merchant cash advances can get a pretty bad rap, rightfully so. And so oftentimes you'll see these merchant cash advance companies kind of changing the name, changing their marketing so that people don't necessarily realize that they're taking out a merchant cash advance. So you need to be diligent. You really need to look. And the main indicator there is ask them what the interest rate is. With a merchant cash advance, they will never tell you because they don't want you to know. Again, they have a fee, but they don't want you to know what that translates into as an interest rate, because that number is astronomical. And a lot of times that, if people realized what they were really paying as a rate there, it would scare them away. So that's the basics of a merchant cash advance. Again, some of those advantages, which there are some, is the main one is the speed. Often within that 24 hours, you can get that funding. And so again, that sounds really nice. But unless your business, you're going to be forced to shut the doors the next day. In most cases, it is not worth it, which we'll get into some of the disadvantages later. But some of the other advantages, they do have flexible requirements. So if you've got some credit challenges, maybe cash flow is really tight and it's harder to qualify for a conventional loan, a lot of times because they're basing it just off your merchant processing, they'll be able to look past some of those other issues, whether you're a startup or have some of those financial difficulties. They're able to just look at your credit card processing and lend to you based off of that. The other is collateral. That and a personal guarantee, a lot of times they don't require it. Again, because they're taking the money before it ever even gets to you, which actually, it sounds good that you're getting the money up front, but that can actually create an additional cash flow crunch. Because unlike a traditional loan where you've got 30 days till your next payment and you can use the money as needed to cover cash flow in between then and now, they're taking it out on a daily basis before it ever even gets to you. And so that can certainly create that cash flow crunch, and oftentimes actually leads to what we call merchant cash advance stacking. And I'll get into what that is in a little bit as well. The major disadvantages, it can be anywhere from 3 to 15 times more expensive on average. I've actually even seen some that are more than that. Their annual percentage rates on most of these typically range anywhere from 14 to 99%. Again, that's if you do the math to calculate what that fee is as a percentage. I've seen them up as high as 350%. They get into the triple digits pretty regularly. Most on average are around 60 to 70%, but certainly much more expensive than any traditional financing would be. And what they do is they actually use what they call a factoring term. And so usually it's either 1.1 to 1.5, somewhere in there, that you're going to end up spending. And so again, they don't term it an interest rate, but you see that 1.1 to 1.5, and that may not seem like a big deal. But if you take out $100,000 merchant cash advance with a 1.5 factoring fee, then you're going to end up paying back $150,000. So you're essentially at 50% that you're paying back, and there's no benefits to prepaying early. You're paying that amount back no matter what for that upfront fee, and that's outside of their high origination fees, which usually range from 2 to 5%, as well as the weekly or monthly servicing fees that they charge as well. So it can get very expensive very fast. Again, some of the other disadvantages, they do have those daily or weekly repayments required, which can in fact impact your cash flow cycles. They also have very confusing contracts. I've looked at a lot of them, and even being in the business, they're confusing. But certainly if it's your first time looking at a financing contract, even more so. They also don't have that same federal regulation, which often can lead to some expensive and stressful surprises, as well as, like I said earlier, I really view these as predatory. They're taking advantage of people in a bad situation that they know are, need their money, and they're going to charge as much as they can for it. but because of that lack of regulation, they're able to do so. And then lastly, again, there's no benefit to repaying early, no matter what. Again, back to that example of the $100,000 with the 1.5 factoring fee. No matter what, you're paying back that $50,000. Whereas with a line of credit from a conventional bank, if you pay that back early, you're paying a lot less in interest because you're only paying on the amount that you actually use. So certainly some disadvantages to take into account there. Another common choice, which I don't view this as bad as the merchant cash advances, but invoice factoring is another common option for businesses that have heavy accounts receivables. The bank in this case, or lender, is going to take a percentage of each of the invoices up front. So typically 1 to 5% of the total invoice amount they're going to take up front, but then they're also going to have servicing fees because they really actually take over your accounts receivable process. All invoices funnel through them, typically through a lockbox, but they're taking full control of that system. And again, they're taking their cut before the money then funnels through to you as the business owner. They're also in most cases taking over the collections process, which sounds like it could be nice up front, taking some of that off your plate. But I've actually seen a lot of instances where this creates issues with the businesses because all of a sudden the customer sees that their payment for their invoice is going somewhere else. There's another company that they're dealing with, and it can be a red flag for some customers. And so that can create issues there. And then they also typically have pretty heavy origination fees. Some of the pros, again, quick access to money without having to wait for your customers to pay. And they approve primarily off of your customer strength. So if your business is weak or your credit is weak, not so much of an issue with AR factoring because they are basing it off of the creditworthiness of your customers because they want to see what the likelihood of them paying those invoices is. The cons, again, very high cost. There's also that risk for issues with your customers popping up. And really, they're kind of relying on the borrower needing that quick access to the capital. That's really their strong push there because we have similar conventional products here at the bank, and most banks do, where you can get a line of credit based off of your accounts receivables as well. So using that same collateral, but much lower cost, and the process of the invoices isn't taken over, so your customers don't face any issues there. So there certainly are better options if you have the time, which we'll get into that in a little bit as well, because the time difference really isn't that great in the long run. So some of these better solutions, which we've touched on briefly already, the first is a term loan. So borrowing a specific amount of money, it's going to have a predetermined term. So typically anywhere from 2 to 7 years, and then it's going to have a fixed monthly payment of principal and interest. And so the nice thing about that is exactly what you're paying every month. It's not like a merchant cash advance where that daily amount could go up or down depending on how well your sales are doing. It's a fixed amount. You're paying down the principal at the same time. This is really a better fit, in my opinion, if you're going to be using all of the money that you're borrowing for specific purposes. And so if you're going to be buying equipment, or let's say you have a big marketing campaign you want to handle, and you're going to spend all that money up front, this is a great fit because it stretches it out over a longer term, so your monthly payment is less. Whereas on the flip side, in the next box, we have the working capital line of credit. This is a similar option in that you get the money for those same purposes, but it typically is revolving. So just like a credit card, you can pay down and reuse that money as needed. Your payments will vary just based off of how much you've used. And so if you haven't used any, your payment that month is going to be $0, but it allows you to have that cushion to use the money when needed. And then you would pay interest only during that 12 months, which is the typical term for a line of credit. At the end of the 12 months, you can either pay off the full balance and close the line, or what's most common is just renewing that line of credit for another 12 months. So that's what most people do. It gives you that flexibility, but it's a better fit than a term loan if you don't know if you're going to use all the money, mainly just, again, because you're not paying interest on the portions that you don't use. So that can be a really good fit for a lot of businesses. especially in the situations like we've talked about, whether you're having a cash flow crunch. You might have an issue making payroll this month because you invested money into other business purposes, but you might not have that same issue next month. And so having it available when you need it, but then not having to pay interest on it when you don't, is certainly a big plus that both the invoice factoring and the merchant cash advances do not offer. So certainly two really good options. Some of the advantages, which we've already chatted a little bit about, but those predictable monthly payments, the significantly lower cost, for an interest rate on a line of credit, you're looking at most banks anywhere from 7.5 to 9.5 on today's rates. Again, the Fed is meeting today and expected to drop rates by 0.25%. Most lines of credit use the Wall Street Journal Prime as their index, and so that rate would drop by that exact amount that the Fed lowers the rates. So you could be looking at 7.25 to 9.25 after today. So significantly lower than that 60% average, sometimes up into the triple digits that we were talking about with merchant cash advances. Origination fees are also lower. Most banks have an origination fee of 1%. Again, a merchant cash advance, you're looking at 2 to 5%. So you can see how that adds up quickly depending on how much you're needing to borrow. 3 is the flexibility in how the funds are used. Term loans, and really it's going to depend on what your needs are and what your goals are. So again, this is where it's so helpful to have a community bank as your partner, because you're not just a number here. It's not a big bank where you just go off into their underwriting system and they see what they can do. Here we take the time to sit down with you to go over what your needs are for your business, what your short-term goals are, as well as what your long-term goals are. And then we can, provide you with a couple different options of what we might be able to offer, see what's going to be the best fit for you and for your business. And so we might have an option where we disperse all the money up front on a term loan. Maybe we hold some of it back so you're not paying interest on the whole amount. Or maybe we look at a line of credit so that you can revolve that as needed. So we really have that flexibility and ability to customize the solution to fit the business owner and the individual's need. And then fourth is the lower risk. Again, because it's a lot of that, is lent to, the cost being lower. It's just going to inherently be lower risk for your business because your cash flow is going to be stronger. And so as, bumps in the road or hiccups come, as they will with any business, you're going to have cash flow and reserves available that you haven't been just funneling into paying a merchant cash advance as those situations occur. So some of the trade-offs here, it does take a little bit longer to access funds for a conventional loan. And so this is really where you need to weigh what's most important to you as the business owner. Because again, you might be able to get, funds within 24 hours with a merchant cash advance. It may take 7 business days for a line of credit for you to get, approved and have the loan close. So it may take 6 more days, but you're getting it at such a lower cost than the merchant cash advance that in my mind, it's totally worth it. Again, unless, if you're faced with closing the doors to your business tomorrow and this is your only option as a merchant cash advance and you need the money today for sure, then maybe it's worth the risk. But in 99% of the cases, if you're able to wait the extra, 6-7 days, whatever it is, to get the funding, it's definitely worth it. It does require a bit more documentation in most cases, but still not anything overly excessive. It may be tougher to qualify for a new or a struggling business, just because we do base it off of cash flow for the business as well as global cash flow. Whereas some of the other options we talked about were based more off of either your credit card processing or your customer's credit ability. And then lastly, it may require some collateral. And so again, that's going back to us talking through your options and what you need and what we have to offer. We'll talk through options regarding collateral as well and whether that's needed or not, what's available to use as collateral, what options might look like for loan amount with or without collateral. So those are all things that we can talk through as well. But really when it comes down to it, those 4 trade-offs there, working with a community bank can help you overcome those trade-offs because we're going to be able to move much quicker than some of the larger banks. And so it kind of mitigates that extra time taken there. The documentation, we help you every step of the way through it. We answer the phone, we, answer questions. And so we're there to help you with the documentation. The tougher to qualify part, the nice thing about us being a community bank is all of the decision-making power is here local. So again, you're not just going off into some underwriting system to somebody who doesn't know you and just looks at the numbers and may decline the loan. Here, we're able to talk through things. We're able to look more logically at every business and at the actual human being behind the business, right? So that we can, get a little bit creative and make things work that wouldn't necessarily work at other institutions. And then the collateral piece, again, we can get creative there and talk through options. So working with a community bank can certainly help, even though those, I don't really view them as significant trade-offs. But if you do, working with a community bank can certainly help mitigate those. So now looking at two side-by-side examples, now that we know what a merchant cash advance and what a line of credit are, if we look at just the numbers side by side, you'll see in both cases here, we're looking at a $50,000 loan. So yes, the merchant cash advance may fund in 24 hours, whereas a bank may take 7 to 10 days or several weeks if you go with a big bank. But then the holdback rate on a merchant cash advance, or an MCA as they're frequently referred to, is typically 5 to 20% of your monthly credit card sales, or a minimum fixed payment, daily or weekly. That's not applicable at all on the line of credit. So you'll see fees, the APR anywhere from 40 to 150% on that $50,000 for the MCA, or a rate of 7.5 to 9.5% on a line of credit. No benefits to the early repayment on a merchant cash advance, while there are benefits on the line of credit because you're only paying interest on what you've used for how long you've used it. And so if you pay that down early, again, it's still available to you to use as a cushion when needed or if needed, but you're not paying any interest if you're not, using it at that time. Looking here at some back to Dr. W's specific situation. So you remember we went through these numbers kind of on a high level in the beginning of this presentation, but now we're going to dive a little bit deeper into what these actually mean for his business, as well as what alternatives he could have looked at. So again, he took out 3 merchant cash advances here, and he became really a victim of what we term merchant cash advance stacking. And so what you'll see pretty regularly is someone will take out 1 merchant cash advance. They'll use the money for whatever purposes they originally needed it for, either to hire some more staff or just for general working capital, maybe some supplies or inventory. And so they take it for that, and they feel like it's great because they've taken out this $100,000. It helps them bridge the gap. But then what they realize usually pretty soon after is, crap, now I've got this $11,250 minimum monthly payment that's totally eating into my cash flow, and now it's creating more problems every month going forward than what I was facing before. And so then they're faced with having to take out a second merchant cash advance. In this case, his second one was $271,000. And he did use a little bit of that for some working capital purposes, but a big chunk of it was used just to pay back that first merchant cash advance. And so now he has an additional $12,000 a month minimum payment that he's got on top of the original $11,250 minimum monthly payment, just so that he could pay back that first one. And then you fall back into that same trap again. So he takes out merchant cash advance number 3, this time even a higher amount, $309,000. Again, some of it, in this case, he used some of it to buy some light equipment and supplies for his dental office, but a big chunk of it was used to pay back number 2 and number 1, which led to a new minimum monthly payment of $30,000 for the third merchant cash advance, totaling $53,250 a month that he was paying in merchant cash advances, when so much of the second and third loans were just to pay back the previous loans that he had taken out. And so he didn't even really get the advantage of using that money to build his practice or to build his business, because so much of it was just to pay off other debt. Luckily, he stopped at 3. I've seen some instances where people have come and they've made it up to 6 or 7, and they're just drowning in debt. And that's one of the worst things that I see as a commercial banker. It's horrible when you see somebody that's passionate about what they do. They've worked their butt off to create a successful business, but now because of some predatory lending like a merchant cash advance, which has led to them stacking those up again to 6 or 7, they're in a situation where they're forced with shutting their business down. They're going out of business. They're losing everything that they have simply because they were taken advantage of by these lenders. And so he fell into a similar scenario again. Luckily, he stopped at 3, but it still was resulting in $639,000 a year that he was paying just towards these merchant cash advances. That resulted in total payback of $890,000. So again, that's $210,000. And these were for the average term for a merchant cash advance is 1 to 2 years. So just to borrow that money for 1 to 2 years, he's paying over $200,000. Plus, you've got to factor in a 2 to 5% origination fee on the full $680,000 there, plus all the servicing fees that they have. So really, when it was all said and done, he spent well over $1 million to get access to that $680,000 just for a year or two. So looking at what he could have done differently and what alternative options would have been available if he had looked at conventional financing. In that first column, we've got that merchant cash advance. So those numbers that we just went over. If we look at that second column, the first one that's labeled term loan, this is if we took a 2-year term loan. So 2 years to match that 2-year merchant cash advance. So we can really see apples to apples what the difference is between a merchant cash advance and a term loan. So same amount, $680, 2 years, but the monthly payment is $30,778. So almost $23,000 less per month that he's able to keep either in the business so that he can run and grow the business, or that he's able to put into his own pocket so he can take care of his family and his own personal needs. Total payback is $739,000. So we're looking at roughly $150,000 less that he ends up spending over those 2 years. So I don't know any business owner that wouldn't benefit from an extra $150,000 over 2 years. So big difference there. The third column is another term loan scenario, but this is more with an average term length of 5 years. So same initial amount, $680,000 for 5 years. That lowers his monthly payment all the way down to $13,726. So here he's saving almost $40,000 a month. It does increase his total payback because the term is longer. And so he ends up paying more in interest than he would on that 2-year term loan option. But even then, at extending to 5 years versus the 2-year merchant cash advance, he still is saving upwards of $65,000, $66,000 over the life of the loan. So still savings there. And then the very last column, you'll see is our line of credit option. And this really would have been a good fit for his initial purposes because it was used a lot for some supplies and inventory, as well as to some small improvements he was making to the practice. And so it would have been a good fit to have that available for him on a revolving basis. So again, $680,000, we've got a 1-year term there because that's the average term for a line of credit, and then he can renew it every year after that. The minimum monthly payment would be $4,817. So, $39,000 less, $49,000 less than what he was paying with his 3 merchant cash advances. And again, the reason the payment is so much lower there is because your line of credit is going to be set up on interest only. So if he made the interest only payments for the full year, that's what he would be looking at. His total payback would be $738,000. But again, that's only if he elects to pay off the entire principal amount at the end of the 1-year term. So even if he did elect to pay it off entirely within that 1 year, which is half the time that he had the money for the merchant cash advance, he still is saving almost $152,000, $53,000 there over the life of that line. But the great thing is, at the end of the year, he doesn't necessarily have to pay back that entire principal amount. There are some lines out there that may have a covenant or requirement for it to revolve annually, which means it does need to be paid down to 0 at some point throughout the year. But there are others that don't. And so he may have the option to continue rolling that principal forward. And again, this goes back to what his goals or needs are as a business owner. His primary goal may be cash flow. And if that's the purpose or the goal, then rolling that principal forward, keeping his monthly payments lower on the interest only, is definitely going to help him meet that goal. On the other hand, his goal may be to get out of debt and to reduce his payments altogether. And in that case, maybe paying off the principal is the best fit for him. Again, that's why having a community bank partner that you can call at any time, talk through multiple options, they can put together some numbers to send over to you, so you can really, see what's going to work for your business, is so helpful. So again, a different path for Dr. W. If he had worked with a local banker, such as us here at Gateway, before going into those merchant cash advances, we could have talked through that with him, because especially in his case, and when I talked to him originally, I asked him why he took out the merchant cash advances initially, and he wasn't even actually faced with the time crunch. But what was advantageous to him was the ease of getting in there without having to fill out as much paperwork or having to go through as many steps. But again, so much of that can be mitigated by working with a really good local commercial banker. And so that was his main reason for doing it. But again, you have to weigh that. Yeah, you saved maybe a couple hours on the front end, but then on the back end, your business is paying substantially more for the financing, and you could hear the stress coming through the phone when I first talked to him. And so saving a couple hours on the front end to go through months and months of being stressed, not knowing if your business is going to be able to pay these loans, not knowing if you're going to be able to feed your kids, is not worth it all, in my opinion. So comparing the costs, terms, the pros and cons of those potential solutions is vitally important. And then saving thousands of dollars while significantly reducing the risk with a working capital line of credit or term loan can definitely be worth it. So again, back to that concern that some people have, is either that it's going to be a really hard process or that it's going to take forever to get approved for a working capital line of credit or a term loan. And while at some institutions you may run into that issue, if you're working with a bank that's local and that specializes in commercial and business financing, like Gateway does, we're able to mitigate so much of that. We're able to streamline the process. Again, all of the decision-making power is here local in our office. And so we're able to get through it much, much quicker than if it, had to go up several levels outside the state, as some of the larger banks do. And so we can help mitigate a lot of that. Some of the key tips on how to qualify right off the bat: just keep updated financials. I know it can be a pain, especially if you're a smaller operation, and I've been in those shoes. I've been a business owner where I kept my own books, and it's a hassle, and sometimes it's a pain. You're wearing a lot of hats, you have a lot of things that you have on your plate, to then also find time to keep your updated financials. But I promise you, it's worth it, not just for financing purposes, not just for the bank's purposes, but for your own purposes as a business owner. Because the more often that you're taking a look at your financials, that you're looking at your key indicators, the quicker you're going to be able to pivot and make adjustments if you see that in the numbers something isn't working. So it's vitally important to keep those updated financials. If you do have a bookkeeper or a CPA that handles those for you, that's fantastic. Again, just make sure that you're reviewing them personally, so that as a business owner, you're staying on top of the numbers and know where you're at and where you want to go. And that leads into that second point there: knowing your numbers is vitally important. The third point here: targeted debt service coverage ratio of 1.25 or greater. So really what that number does is that measures your ability to pay back debt. So a 1.00 would be a break even. Essentially, that means for every dollar that's coming into your business's revenue, there's an equal dollar going out of your business for expenses. So a 1.25 means that for every dollar going out in expenses, you've got $1.25 coming in revenue. So essentially it gives you a 25% cushion after your debt's paid and everything for any, unexpected expenses or anything like that comes up. So banks like to see that because it makes sure you can cover your business expenses. We do a global cash flow, so it also makes sure you can cover your personal expenses. You can cover the payments for the new loan, and you still have that 25% cushion. So that's good for two reasons. One, it protects us as the bank to make sure that the loan will be paid back. But two, for you as the borrower or the business owner, it also helps make sure that you have the ability to repay those loans and have that cushion for your own safety and benefit. Back to merchant cash advances, they don't do a debt service coverage ratio like that in most of their cases. And so, looking at Dr. W, he took out those three. They didn't really care if his business had the cash flow to support paying those back because they knew that they were going to be able to take that from his credit card processing before the money even touched his hands. So at the end of the day, if the money wasn't sufficient for him to pay his expenses, it didn't affect them unless he went fully out of business. And so they're not concerned with the well-being of the customer. Whereas we, that 1.25, again, it's for us and for the customer to make sure that the business is safe and sound. Next, don't take on high cost debt. There are so many better solutions out there. And it's not worth it for those quick, instant benefits that you may perceive. It's not worth it for the effect that it has on your business in the long run. Next, monitor your personal credit score. Most banks will look at your personal credit score. Again, it's not necessarily because you're personally going to be paying back the loans, even though the business will be and you will be. But the main reason is just to look at your payment history, to look at what your track record is for paying back other loans. So keeping your personal credit score up is definitely something to pay attention to. Next is working with an experienced local bank that can guide you through the process. So again, having experts on your team, whether it's a CPA or an insurance agent or a real estate agent or whoever those experts may be, just can make the process so much smoother for you. Again, take stuff off of your plate that as a business owner, you can focus on your expertise and what is really most important to you by having people that can give you guidance there. Other helpful banking solutions. So I get asked a lot, how often before I need a loan should I reach out to a bank? And the answer is you can never reach out too soon. So whether you need financing in a week or you might need it in 10 years, start developing that relationship now, because the more you have that relationship, the more you're going to be able to chat through potential options. You're going to be able to, kick around maybe some potential growth plans you have. And it's just going to make the process so much better for you in the long run. It's also going to alleviate a lot of that stress when those, things do come up. You're not going to have to wonder where you're going to turn or what you're going to do, because you're already going to have solutions and people in place to help you with that. So again, some alternatives to invoice factoring are to use your accounts receivable as collateral for a line of credit. It's going to give you a standard interest rate, lower upfront fees, and just less hassle in the long run. Next, checking, savings, money market accounts. Local banks are able to offer all of those things. But again, that lends to having that relationship more established. And so if we've got a customer that has had their business checking account here forever, they come and they say, hey, we need a line of credit where, we've got this great opportunity to grow, but we need to act now. Having that history with the customer is going to help us to be able to make that decision more quickly and more easily. We're also going to have a lot of their information already. So it's going to make the process easier for them when they apply for the loan. On the flip side, if you don't have that relationship, that certainly shouldn't prevent you from coming and applying for a loan. But again, it's just going to help streamline the process if you already do have that depository relationship with the institution. Some of the other great things that we offer here specifically at Gateway Bank is a 5% earnings credit on all analysis business checking accounts for banks. So, you get a lot of banks that are, heavy fee driven banks. And so they're charging a lot of fees to their customers, which can really add up. We're not a heavy fee driven bank in the first place, but on the second hand, we also have this 5% earnings credit available so that if you do have fees that are incurred on your account for any elective services or anything like that, those are covered by the 5% earnings credit. And so in most cases, businesses that have that analysis business checking account are able to take advantage of that and never end up paying any fees. We also have additional protection for deposits over $250,000. So if you remember several years ago, there was the regional banking crisis. A lot of deposits over $250,000 weren't fully secured or insured. which created a lot of panic among consumers and businesses, rightfully so. And so we have options in place which can give you full protection and insurance on at no additional cost to you on any amounts that you have over that $250,000 as well. So again, working with a local bank that specializes directly in businesses on the deposit and lending side can just help make sure that you're aware of all the options available to you in your business that otherwise you may not know. We just had, it was, let's see, 2 weeks ago, we just had a new customer that came in. He had been with a bigger bank. They had some wire fraud. It was a $50,000 wire. And so it was kind of the last straw for them. They decided they wanted to be with a local bank. We were able to talk through a lot of options with them, provide them with the exact type of account structure they needed. But we found out that where they were before at this larger bank, they weren't insured for their amount over $250,000, and they had well over that in their account. And so even though, you're at a big bank, you feel like you should be getting the best service, a lot of times, either things slip through the cracks or they just don't even offer or discuss those options with you. So here we have those, and we're able to sit down and counsel with you and figure out what's going to be the best fit for you. So in conclusion, the top 3 tips for success, again, start developing that banking relationship sooner rather than later. Even if you're, don't want to move your accounts now or don't want to apply for a loan now, just start it as soon as possible. Just even a conversation. Again, that's the great thing about a community bank is you know who your banker is and they know who you are. So just putting a face to the name, starting to develop that relationship can go a long way. That leads into number 2, bank local when you can, especially as a local business. That just ensures that 1, all the money stays right here in the community. But 2, we also invest a lot back into the community, whether it's through, charity organizations or other local businesses. So it just supports the local economy and helps build everyone up. And then lastly, consider conventional term loans and working capital. At the very least, consider them if you're thinking about taking out a merchant cash advance, an invoice factoring loan, or any type of alternative factoring. Please at least consider those conventional options. You may still decide that some of those options are better for you if that's really your only option. But at least comparing the other options to make sure that you're making a sound decision can really go a long way. So please feel free to reach out. That's my email address there, joshf@gcbaz.com. Reach out. We can set up a time to jump on a phone call, meet in person, whatever you prefer. If you have questions, if you just want to even talk through your specific situation, again, even if you don't decide to bank with us or to get a loan from us, I'm happy to look at other financing options you have and tell you if it's a good option or not, what the pros and cons may be, so you can weigh that. So please don't hesitate to reach out. And then lastly, we do have an appendix slide here. I won't go through all of it, but this is Dr. W, more in depth on what his loans did to his personal cash flow. Again, we talked a little bit about having a debt service coverage ratio goal of 1.25 or better. You'll see before he took out the merchant cash advances, he was at a 6.4. So almost 5 times better than what a bank would require. His EBITDA, or his take-home income essentially, was $668,000. So you can see he was doing very well. After the merchant cash advances, it dropped down to a 0.90 for his debt service coverage ratio, which means he was not even at a break even. Again, he still was making that $668,000 in EBITDA, but because his total debt service was $743,400, he was actually having to put money into the business just to keep it afloat and pay those loans. And then if you look at the other examples, we've got a line of credit, that same 2-year term and the 5-year term option that we discussed before. You'll see with the line of credit, if he had gone that route, his debt service coverage ratio would still be a 4.12, so much higher than the 1.25 needed. Even with the 2-year term, he's still at a 1.41, so still very strong. And with the 5-year term, he's at a 2.48. So again, those options would have saved him a ton of money, would have made him more attractive to banks if he did need other financing in the future, and would have alleviated a ton of stress. So please consider all your options. And again, if you have any questions, I think there may be some in the comments, but if you have any outside of this, please feel free to reach out.
Awesome. Thank you so much, Josh. That's so helpful, I think, for all of us just to know about red flags to watch out for and other smart solutions to consider instead that might not be as common, but way better options to consider in the long term. And thanks to all of you for spending some time with us this morning or afternoon and sharing your questions. Again, if you have questions, this is a great time to put them in the chat and I'll read them aloud so that Josh can answer. Josh, the first question that we received is if you could just clarify the key differences between a working capital line of credit and a term loan, and if those interest rates are fixed or variable, especially on a working capital line of credit.
Yeah, great question. So the key difference is the working capital term loan is really going to be fully fixed. So it's got a specific term, either 2 or 5 years to pay back the full amount. There's typically not a balloon with a working capital term loan. So if you've got 5 years and you take out 100 grand, you're paying back that full 100,000 plus whatever the interest rate is over that 5-year period. Typically, it's going to be a fixed rate for the entire period. There's some other term loans out there, like if you take out a commercial real estate loan, where the rate may adjust every 5 years, is pretty common. Whereas on a working capital term loan, the rate is typically fixed for the entire period of that term loan. So you know what the rate is, you know what your payment is, that's never fluctuating. The line of credit is where you may see some differences there because again, it's a 12-month term, so shorter, but it revolves and it can be renewed annually. Really the only reason, I'd say probably 99% of our lines of credit renew every single year. The only reason it would ever not renew is if one, the borrower just decided they don't need it anymore, or two, if there's a serious adverse change to the business or its financials. So if there was, say the business owner died and maybe the son steps in to run it, but it's just all the relationships are gone and their revenues drop by 50%. In most cases, we would try to work out something maybe for a lower line of credit, but that could certainly cause it to not be renewed. And then the interest rate on the line of credit, it's interest only, so you're only paying on what you've used. But in most institutions, that line of credit interest rate is going to float as well. So very typical for it to be set at the Wall Street Journal Prime, which is currently 7.5%, plus let's say 1%. It's a pretty common spread on those. So you'd be looking at 8.5%. But after today, if you had a line of credit already at 8.5%, if the Fed lowers the rates today by 0.25%, tomorrow, or whenever the next scheduled change to your rate is, it would drop to 8.25%. So you certainly can take advantage.
So it sounds like those variable rates can either work in your favor or create some additional risk there.
Yeah.
So just something good to know. Yeah.
And back to having that relationship can be super important because knowing, and again, nobody has a crystal ball, but if we think rates are going down, that line of credit, it's great to keep that in place, take advantage of that. On the flip side, if we think rates might be going out, maybe it's time to term that out into a term loan so that you can fix that rate and not have to continually, have the rate increase or things like that. And then maybe 2 years from now, it lowers again and you refinance your term loan, pay it off with a line of credit so you can take advantage of it going back down. So there's certainly options there.
That's a really good distinction to know about, again, some of that benefits of having the relationship with your bank and being able to be flexible there. Another question that came in was how you were talking about the speed of access to funds between MCAs, merchant cash advances, and line of credit and term loans. So somebody asked, if I need funds quickly, how much longer does it really take to get a line of credit or a term loan compared to an MCA?
Yeah, that's a great question. And there's really, I would say, 3 factors to that with any bank. So not just with Gateway Bank, but the first is going to be on the borrower's end, how quickly you're able to gather the documents that are needed. So typically, we're going to want to see some business tax returns and financials, an application, a personal financial statement, and then personal tax returns as well. So most of it's information that most people should already have pretty accessible. You will have to fill out that personal financial statement in the application. But however quickly you're able to get that to the lender, obviously the quicker you get it to them, the quicker they can start their process. So that's number one. Number two, I would say, is the lender or the bank's workload. And so I would have a frank discussion with whoever you're applying to and to say, hey, if I get you all of this today, how quickly are you going to be able to get an answer back? And then number three, I would say, is the loan amount. So every bank has different approval authorities based on limits. And so if for instance, at our bank, if it's under $250,000, I can approve that myself. And so I've had instances where I get a full loan package. I'm able to review it that same day, approve it, and then send it up to our loan operations team that same day as well. And it typically takes them a day or two to get loan documents out. So we've had some, actually quite a few, fund within 2 to 3 days of getting the full package. So not much longer than that 24 hours with the merchant cash advance. And even some merchant cash advances take that 2 to 3 days. If it's a higher amount, say it's our limit, if it's over $1 million, it has to go to our loan committee as well. So that can add a few days. But again, just having a frank discussion with your lender, saying, here's when I expect to get you my documents. Here's the amount I'm looking for. How quickly do you think we can put this together? And then they should, give you a straightforward answer and help you make that decision.
Yeah, great suggestion to put the ball in their court as well and ask, if I deliver all of this to you, what kind of timeline can I expect there?
Yeah, and there's always some, unknown variables. You might get them everything that same day, but they might have some questions or maybe some red flags pop up and they need to clarify things with you. So that can certainly add a little bit of time, but for the most part, it should be pretty straightforward.
Wonderful. Thanks so much, Josh. Well, I know we're at time here, but if anyone has additional questions for Josh, please feel free to reach out. Josh, can you share your email again that people can reach out to you?
Yeah, so joshf@gcbaz.com. So joshf@gcbaz.com is my email. You can also call in here to the bank, or you can call my cell phone as well. Happy to talk anytime. 480-518-5246 is my cell phone. So again, happy if you just have questions or want to discuss potential options, happy to help.
Whoa, not sure where else we'd get the cell phone for the CCO of a bank. That's valued information. Thanks so much, Josh. And for everybody who's watching this replay, we're going to be sending out this recording. So feel free to refer back to it, share it with your network, and reach out if you have any other questions. Thanks so much for joining us and have a great rest of the day.
Yeah, thanks, everyone.